Good afternoon and welcome to today's webinar. My name's Tim Ward and I'm the Financial Advisor here at FWA Chartered Accountants. Today's webinar, we'll be looking at the dangers of direct personal insurance. So in this day and age, a lot of people are aware that the internet is used as the first point of engagement and research for basically any particular topic or item. And direct insurance and insurance in general is just part of that also. So today we're going to be exploring these themes and having a looking at direct personal insurance. So with today's agenda, we're going to start off having a look at Australia's under-insurance problem. Some of the dangers involved with purchasing personal insurance cover via the direct providers, provide a comparison between direct insurance providers and retail insurance providers, and then lastly look at a case study which will involve a comparison just in a little bit more detail. So just looking at some of the current trends. So in the last 5 years, Australia's direct life insurance market has experienced some significant growth. The number of direct life insurance products has increased from 109 back in 2008 to 196 as of 2013. So this is an increase of 80% in 5 years. So you will have noticed that you can't turn on the television these days without seeing a direct insurance company advertise the benefits of having life cover or salary continuance or a funeral plan. Actually, currently the direct insurance advertisements seem to be more prevalent than the sports betting agencies at the moment. And these direct insurance providers, their claim is to be easy, hassle-free, and offer great policies which are excellent value for money. What the direct insurance providers are doing a good job of is creating an awareness as to the importance of having personal insurance cover. However, the reality is that whilst most Australians insure their homes and cars, they tend to neglect to insure their most important asset, themselves. So just looking at Australia's under-insurance problem. So a recent report was conducted by KPMG into the under-insurance disability protection gap in Australia. And what they found was that within that research project, they were commissioned to measure the level of under-insurance in Australia in respect to employed people between the ages of 18 and 64 and the consequential impacts on the social security benefits. And what they came out with was that Australians are underinsured by more than $300 billion. So some of the key findings that they've had on the back of that research project was that 1 in 3 Australians have no income protection, and also 35% of Australians have no form of disability insurance. And lastly, the Australians in the age group of 45 to 64 are the most underinsured, so to the tune of 77%. So some pretty startling sort of statistics that came out of this report. And also the underinsurance represented in the study also provided an insight into the significant costs to the Australian economy. So the annual assistance to disabled people and related services was estimated by the Australian Treasury to be within the tune of $24 billion in 2012 and 13, of which $14.8 billion related to the actual disability support pension. And the reality is that most people could not survive on the disability support pension given the current levels of assistance. So the current disability support pension provides about $19,544 per annum. So I think most of you would agree that that would not be enough to cover your standard basic living expenses. So with our underinsurance problem in Australia, you'd think that direct insurance products would be reducing the problem. The direct insurance providers may have a short-term impact on the underinsurance of individuals. However, the direct insurance policies have extremely high lapse and cancel rates and have very limited claims data to provide any meaningful examination into the benefits of these direct providers into Australia's underinsurance problem. One of the other factors is with direct insurance providers, they have relatively low maximum sums insured available. So you're typically looking at sort of a maximum of $1.5 million worth of life cover, and only being able to get up to $1 million worth of TPD cover, total and permanent disability cover. So whilst that those sums insured may be appropriate for some individuals, there are many other Australians out there that would need a lot more cover than these maximum sums insured provide. So what is direct personal insurance? So direct personal life insurance is sold directly from insurance companies or from financial service providers, and there's generally no financial planner or advisor involved, and the cover is relatively quick to apply for, with no medical history required at application time. So direct insurance products are typically offered via TV, radio, and online, promoting quick and easy insurance applications. So I thought it'd be a good idea to just break down and have a look at some of the key differences between these two types of policies. Firstly, in the table here, we've got underwriting. So underwriting refers to having your medical history reviewed so that the insurer can assess as to what your likelihood or risk category would be based on your current health circumstances. So you can see that retail insurers, retail insurance, which is provided by financial planners and advisors, requires full underwriting. So that's where your full medical history is required up front for those policies. And typically with direct insurance, there's no medicals and or blood tests required for applying for any of those levels of cover. Next, we've got sums insured for life cover. So with retail insurance policies, it's unlimited. There's no cap on the maximum of life cover that you can apply for. Whereas, as we noted earlier, that about 1.5 million is the maximum for life cover with direct providers. Total and permanent disability cover, you can apply for a maximum of 15 million with retail insurance providers, and up to a maximum of 1 million for direct providers. Also, next we've got trauma cover. You can see there's a maximum of $10 million that you could apply for, and typically with direct insurance providers, you can only apply for up to $750,000. Next key issue is interim cover. So essentially that provides cover once you've submitted your application. You are covered up to a maximum of about $1 million with a retail insurance provider. And then obviously with direct insurance, because there's no underwriting involved, they don't offer any interim cover. Next, we've got cover available inside superannuation. So retail insurance providers, you can apply to have your policy owned by a superannuation fund and have the premiums funded via your superannuation. Whereas this is not the case for a direct insurance provider. Premiums cannot be payable via any form of superannuation. Next, advice. So this is a pretty important point that, yes, with a retail policy you do get advice as to a needs analysis as to what level of cover that you would need. Typically with a direct insurance provider, no advice is offered. So it's referred to as a general advice. So no specific recommendations are made about your personal needs or circumstances. The next is cost. So the cost of premiums for this type of insurance. Typically, retail insurance providers are quite low, and then with direct providers, they're actually quite high, despite the claims that you hear on the TV ads. So we'll have a look at that in a bit more detail later on. And then lastly, the marketing channels. So typically your retail insurance providers are provided by your financial advisors and risk advisors. And as the name suggests, with direct insurance policies, their marketing channels are through television, telemarketing, direct mail, and online channels. So what I've highlighted here is the sort of the top 10 dangers, if you like, of taking out cover via direct insurance providers. And we're going to look at these 10 items in a fair bit of detail. So first off, we've got lower maximum sums insured offered by direct providers. Number two, the trauma cover that direct providers provide does not have a reinstatement option. Three, we've got income protection only offered in indemnity style policies. Four, TPD policies typically only offer any occupation definition policies with direct providers. There's a high cost of premium with direct providers. Limited customization available for the policies with direct providers. 7, serious illness cover or trauma cover, as it's commonly known, has limited coverage of conditions with direct providers. 8, short benefit periods for income protection policies. 9, pre-existing medical condition exclusions. And lastly, no support or claim services offered in the event of claim. So we'll kick off and explore these 10 items. So first off, we've got lower maximum sums insured offered. So with your life cover, you have unlimited sums insured available for retail policies and a maximum of 1.5 mil for direct life cover. With your TPD, we've got 15 million that you could apply for via a retail insurance provider, and only up to $1 million with a direct insurance provider. Trauma cover, you could apply for up to $10 million with a retail provider, and up to $750,000 for a direct provider. So you can see there's quite a variance between retail and direct with regards to the maximum sums insured offered. Number 2, trauma cover does not include reinstatement options with direct providers. So a reinstatement option provides the policy holder with the ability to repurchase 100% of their trauma insurance 12 months after a claim benefit has been paid. So essentially, this option allows a life insured to maintain their policy in the event that they suffer another trauma event. So this is a really crucial bonus of having a policy, a trauma policy via a retail provider, as this reinstatement option is not available via your direct providers. Next, we have income protection only offered via indemnity style policies with direct providers. So with an indemnity policy, you are insured for what you say you earn, but if you make a claim, you have to verify your income at claim time. If your income has reduced since you applied for cover, your claim will be paid on the reduced benefit. So we also have another type of income protection policy called agreed value, and this is where you prove your income at the time of application and lock in a set monthly benefit. So the advantage is that you know what you will receive regardless of changes in your income. So you can imagine that having an agreed style policy will provide that greater level of certainty dependent on your occupation. So obviously there are people out there with occupations where their incomes will fluctuate from year to year. So it's pretty important for those individuals to be eligible to have that extra certainty in the event of claim, knowing that they'll receive their entitlement. So currently, direct insurance providers only provide indemnity-style policies. So this can be a big disadvantage for those people with occupations where their incomes do fluctuate. Next, we're looking at TPD, so total and permanent disability, where it's only offered as an any occupation definition via direct providers. So an any occupation definition means that you'll be eligible for cover if you become unable to work in any sort of job and never expect to return to the workforce. So this is different to the other type of TPD policy that you can apply for, which is known as the own occupation definition, which means that you can claim if you suffer a disability that means you're permanently unable to work in your current occupation. So that's a big difference. One of the easiest ways to explain. So also you'll also continue to be eligible to receive the benefit even if you continue working in a different occupation that is not impaired by your disability. This is for the own occupation definition. So you can see that it's a much more generous definition than the any occupation definition. So, for example, if you take a surgeon who permanently damages his or her hand and is no longer able to perform surgery, will they be covered? Will they be covered under the own occupation definition? So, had that surgeon had the said surgeon be able to perform other jobs, then and would not be covered by a policy with an any occupation definition. So that surgeon, if they had an any occupation policy, they could potentially be seen to have another occupation as a lecturer at university or a teaching role, not a hands-on occupation. Whereas if they had an own occupation definition, they would receive immediate payment and would not affect their ability to perform another occupation. So it's quite a more generous policy offering with the own occupation, and typically own occupation TPD is not available via your direct providers. Next 5, we're looking at the high cost of premiums. So what I've done here is I've done some market research on, you can see there at the bottom with the assumptions, a 32-year-old male, white-collar, non-smoker, as to what the same level of cover for life, TPD, trauma, and income protection via a direct provider versus a retail provider. And just to have a look at what the variance is in premium. So you can see there for the $1 million worth of life cover, that the direct provider is $1,100 a year for the premium, and for a retail provider for the same level of cover would be $739. So that's nearly a 50% difference there. With the TPD cover, so this is just for an any occupation style policy, because we can't apply for a own occupation TPD via a direct provider. So we can see there with the direct provider, $620 of annual premium, and for the retail provider, $459 worth of annual premium. So it's a 35% increase for the direct cover with that style of policy. Next, with the trauma cover, for $500,000 worth of cover, it's very close, so only a 4% premium difference there. However, we'll have a look in a bit more detail later on that they're very different policies, and what's covered under a retail policy is far more comprehensive than the direct providers. And lastly, with the income protection cover for $5,000 monthly benefit with a 30-day waiting period and a benefit period of 5 years. So we can see there that the direct provider is nearly twice as expensive for that type of cover, and that's also an indemnity style policy. So there's about $1,000 difference had this individual received advice, and he would have actually saved $1,000 in annual premium by receiving advice. So just a few things to look at there. So some of the reasons behind the variance there. So I guess with your direct providers, they've got a lot of marketing costs. So at the end of the day, the cost of the TV advertising is actually passed on to the end consumer, and this goes against the perception that by going directly to the product provider and not seeking advice, it would be cheaper. However, in reality, we can see that this is not the case. Next, we're looking at the limited customization available with direct policies. So that there's an inability to change the ownership of the policy if you so choose later on down the track, an inability to change the features and add options. You'd have to cancel a policy and apply for a new one. This is not the case for a retail policy where you'd get advice. You can add options and increase cover quite easily. And lastly, the inability to fund premiums from superannuation with direct providers. So not only does this have a greater impact on your own cash flow, but also there are some benefits of having some levels of cover held by superannuation, if appropriate, whereby the super fund will be eligible for a tax deduction on premiums paid for life insurance. So there's a few options that are not available by your direct providers that are with the retail providers. Next, with your serious illness cover or trauma cover, there's limited coverage. So as I said before, they're not as comprehensive as your retail offerings. Typically, the direct insurance policies have a maximum of 15 conditions covered, and these are very simple, basic covers, whereas the comprehensive retail trauma policies have over 40 conditions covered, and they also have the ability to claim on partial benefits. So you might not satisfy for a full lump sum. However, if you meet a definition for one of the partial benefits, you may be eligible up to 20% of your lump sum cover, whereby this type of partial benefit is not available by the direct providers. Next, we have short benefit periods for income protection. This is quite a crucial difference between the two types of insurances. So with your direct insurance products, typically they have a maximum benefit period of 5 years, whereas the normal benefit period for your retail insurance policies is to age 65. And what this means is that in the event the life insured suffered a serious illness or injury and went on a long-term claim, potentially claiming all the way to retirement age of 65, then they would be worse off with a direct insurance policy. So I've just highlighted an example here of a 30-year-old earning $90,000 today if they were to suffer a serious illness or injury that prevented them from ever returning to work, the cumulative benefits payable under the direct policy over a 5-year period would be approximately $459,000. Whereas if this individual had a retail insurance policy with a benefit period to age 65, they would receive close to $6.5 million over that period of time. So this variance of future income is quite significant, and it's really crucial for individuals to be aware of that. And I've just listed there some common examples of long-term claims. So the mental illness is a big one, multiple sclerosis and chronic fatigue syndrome. There's some of your bigger instances where you see individuals that are on long-term claim right from an early age right through to retirement age. Next, pre-existing medical condition exclusions. So with your direct insurance providers, they provide an exclusion for any pre-existing medical condition. So what is a pre-existing medical condition? So it's typically a condition which you're currently receiving treatment for, or you've been diagnosed with in the past by a medical practitioner or professional. So an example of a pre-existing condition may be diabetes, high blood pressure, asthma, any chronic disease, or any conditions diagnosed by a medical practitioner. And typically, direct insurance providers will not cover individuals who have a pre-existing condition for the 5 years prior to the commencement of their policy, which leads to a claim. So typically, this exclusion clause is buried in the fine print of a product disclosure statement, and most people will not be aware of this clause. So what I've got here is I've just pulled up a clause from a product disclosure statement for a direct insurance provider, and just to highlight what that terminology states. So a pre-existing medical condition can be any sickness, injury, or medical condition that you had or had symptoms of at any time in the 5 years prior to the start of your policy, whether diagnosed or not, for which you sought treatment or advice, or of which you were aware, or of which someone in your position should have reasonably been aware. So it's quite a catch-all type exclusion, and the 5-year time frame is quite crucial as well. They go on to say the following are also considered to be pre-existing medical conditions for any stroke, hemorrhage, or heart-related event if apparent in 5 years before you started your policy. So this includes having a BMI of 40 or higher, having high blood pressure exceeding those readings, high cholesterol reading, and being a diabetic with any of the following: kidney disease, renal therapy, neuropathy, and admittance to hospital for treatment of diabetes. So you can see that they're quite. It's quite a significant exclusion that's part of the policies with direct providers. So I just wanted to highlight that these don't exist with your retail providers, because you'll be conducting underwriting and filling out your medical history via an application, and this is why there's the price difference between the two types of policies, and also the best thing with the retail policy is you know upfront what you're covered for. So you'd hate to be caught out with a pre-existing medical condition exclusion whereby you're paying premium and 5 years down the track you want to make a claim, and it so happens that you get caught with a pre-existing medical condition exclusion. So it's really a crucial difference between the two types. And lastly, no support or claim service offered by direct providers. So typically, the life insured will need to contact the insurance company directly when they need to make a claim, and will not have the support of an experienced professional in the event of claim. This is in fact the most important time for the life insured. One of the main benefits of having retail insurance policies and having received advice from an experienced professional means that you'll receive support when you need it most at the time of claim. In the past, I've guided many of my clients through the claims process, and this goes from organising lodgement of claim forms, supporting any medical information, any doctor's reports, to liaising directly with the insurance company on the client's behalf. The service I've provided to my clients ensures that they can focus on their own health and a speedy recovery without the need to worry about dealing with an insurance company and filling out forms, because the reality is that's the last thing you're wanting to do in the event you're suffering from a traumatic illness or injury. So next I wanted to just highlight a case study for the differences between a retail offering and a direct insurance provider. And so what I've got here is just a male, age 32, non-smoker, white collar, married with a child, has an annual income of 80,000 and including super, and has a mortgage of 600,000. So without detailing the specific insurance needs, the approximate levels of insurance needs are to have $2 million worth of life and TPD, $500,000 worth of trauma cover, and a $5,000 monthly benefit for the income protection. So for a direct insurance provider, I've highlighted what the annual premium would be for this individual and how much it would cost. So for $1 million worth of life cover, it'd be $1,100 a year. For $1 million worth of TPD cover, it'd be $620 a year. For trauma cover for $500,000, it'd be $825 a year. And for income protection, with a 30-day waiting period and a benefit period of 5 years, would be $971. So just a bit over $3,500 for annual premium for this individual to take out those sums insured with a direct insurance provider. So how does this compare with a retail insurance offering? Well, for starters, the individual will be eligible to apply for higher sums insured. So they'll be able to apply for that $2 million worth of life cover and TPD that they identified that they had a need for. And we can see that the actual life cover itself for $2 million worth of cover, if we go back and have a look at the direct offering, only for $1 million worth of cover is it costing $1,100. And for the retail offering, for $2 million worth of cover, it's actually $946. So not only are you getting twice as much cover, but it's actually cheaper. So that's a pretty crucial difference from a pricing perspective. Next, with the TPD cover, applying for $2 million, and this is the own occupation style contract. So that would be $1,065 of annual premium for this individual for that type of cover. Yes, this is more expensive than the TPD cover available via the direct provider. However, this individual is getting access to the own occupation definition, which is providing a greater level of certainty in the event of claim. Next, we've got the $500,000 worth of trauma cover with a reinstatement option. So, as we highlighted earlier, that's a really great enhancement to a trauma policy to be able to claim on an event, be it that you had cancer, you'd be eligible to claim cancer, and in 12 months' time reinstate the policy. And God forbid if you had another trauma illness, be it a brain tumour or a heart attack or something, you'd be able to claim on it again. So that's a really key difference to the direct insurance provider, whereby they can't offer that reinstatement option. And then to the most crucial, the income protection cover. So we've got the same monthly benefit with the same 30-day wait. However, the benefit period is payable to age 70, and it's an agreed value contract. So it's locked in, prove your income at time of application, and you don't have to provide any further financial proof in the event of claim. So I just want to go back to the direct provider, where this provider has a maximum benefit period of 5 years for the same monthly benefit with a 30-day wait for $971 per annum. And for the retail policy, it's actually a cheaper premium, and you're getting a benefit period to age 70 and an agreed value contract. So that is a substantial increase in benefit for a cheaper premium. So overall, yes, it's this individual, if they were to take out a retail offering, it is more expensive. However, we're not really comparing apples and apples, because the comprehensive cover available with this policy far exceeds the options available by the direct offering. So the key differences, we've really just highlighted through those, that the life insured would have the correct level of life and TPD as per their needs analysis. The retail life cover is cheaper than the direct provider, even though the retail provider is covering $2 million worth of life cover, whilst the direct provider is providing $1 million worth of cover. The TPD cover is an own occupation definition policy. The retail trauma cover has the reinstatement option and also covers over 40 conditions, whereas the direct policy covers up to 15 conditions. And lastly, with the income protection. So not only is it cheaper than the direct provider, but you'd be eligible for the agreed value policy, a benefit period to age 70, which is not available with direct providers, and lastly, the claims indexation option included in the retail policy. So that's whereby in the event that you had to claim on your policy and you were on long-term claim over multiple years, your monthly benefit is indexed with inflation right up to the time when you cease your claim. So be that when you go back to work when you're healthy again, or right up to age 70 in this case for this particular individual. So that brings us to today's offer. So for today, for the first 10 respondents to today's webinar, you'll be eligible for a free 1-hour consultation regarding your own personal insurance needs. And to take up the offer, you simply just have to email myself at tim@fwo.net.au. So please take advantage of that opportunity. And I'd like to take this opportunity to thank you for your attendance today. And hopefully you've been able to take away a few things that you didn't quite know regarding the direct insurance offerings and the great difference between taking out a retail insurance product via an advisor, a financial planner, and really taking advantage of that advice that you do receive from the advisor. So thank you for that, and thank you for attending today, and thanks.